Welcome to Markets Now. I'm Michelle Rook along with Darin Newsom, Senior Market Analyst with Barchart. And we're closing mixed in both grain and livestock futures trade today. And Darin, let's start off talking about the wheat market. Of course, we've been rallying here this week and just a little bit higher close today. But the funds have been really chasing those Black Sea headlines, haven't they?
They certainly have. I mean, it just depends on how these headlines are being fed into the algorithms. And I mean, it was a wild day in wheat. At any given time, you could see this thing rally or fall 20, 25 cents, just again, depending on what the latest quote unquote news was. So, it was interesting. And I think a lot of it did have to do with algorithm trade. When the dust had settled, the September contract had lost a penny and a half back to the December after gaining 2 cents on Wednesday. So again, it just pushes that spread right back into bearish territory, telling us there is no real scare right now, at least short term, in global supply and demand.
So the funds were really short in that Chicago wheat market. Is this been mostly short covering, do you think?
I think so. If we look at the changes in open interest in the Chicago wheat market, it certainly looks like there's been a lot of short covering in the September contract. Now, the question I had coming into Thursday's session was, looking at the changes on Wednesday, were those short positions being rolled out to December and March, or were those contracts actually seeing new buying interest? It was hard to tell just looking at the numbers. But again, the spread activity would tell us, maybe there was some new buying coming in, but it seemed, if so, it certainly seemed to run out of gas, about midway through Thursday's session.
Yeah, because what is your overall take on how this is going to impact global grain supplies or exports on the wheat side of things?
On the wheat side of things, the world has reshuffled the deck on supply and demand, and largely, the U.S. was dealt out, which really surprises nobody. But the longer this situation goes on and the more damage that's done to the ports and the more restrictions that are put on Black Sea shipments of grain as a whole, I do think it does open the door down the road, possibly. And if that isn't as vague as I can make it, I'll try to make it even more so. But if that possibly opens the door to some interest for U.S. supplies at some point. Right now, we've also got a weaker dollar, a weaker U.S. dollar. So we'll see how long that lasts. If the dollar starts to turn, starts to go up, I think it's going to dim some of that possibility of folks getting interested. But right now, long term, I think there is a chance.
And it's been interesting because there's been a lot more corn that's been exported out of Ukraine than wheat, but wheat has been probably the one that's reacted more. But the corn market has been trading weather. Today we set back. Was that profit taking or hedge pressure? I didn't see a change in the weather forecast.
Yeah, just to quickly finish off the wheat. Yeah, they were holding still a net short of non-commercials or funds were still holding a net short of 40,000 contracts as of a week ago Tuesday, as reported in the latest CFTC report. So in the corn market, I do think it was more hedge pressure because this looked to be a gift. I mean, rallying more than 80 cents over the span of 4 or 5 sessions unexpectedly at the end of July, looking ahead into August, when we know we're dealing with more acres. And so far, weather has been better than what many had expected. So I think this was viewed as a gift. And I do think we saw some increased hedge pressure, some increased contracting going on for the 2023 crop.
Yeah. Did we see profit taking in the soybeans as well? I mean, we've had a heck of a run off the lows. I think from the low to the high here recently has been like $3 in the November.
Yeah, it's been an incredible move. And, that's one where funds were still long. They've been building, they've been adding to their long position. So I do think that, as we watch Thursday play out, given that it seemed to run out of gas, I would say that was more profit taking rather than hedge pressure at this point. So, again, fundamentally, soybeans are quite bullish. At least if we look at the future spreads, we have to wonder about demand, not only for this marketing year, but next marketing year. But I do think as we look at the closes on Thursday, that had more to do with fund profit taking.
Sure. Longer term, do you think that the fundamentals are bullish enough? I mean, we're very close to the contract highs again. Are we bullish enough to get pushed over there, especially if we start to see this yield come down at all?
If I throw out everything that I think I know about supply and demand, weather, acres, and these sorts of things, and I just look at future spreads, it tells me that, this market's bullish and it's going to be bullish for a long time fundamentally. But we also, if we start adding some of those things back in, the weather's been better. That might have been the lowest production number we see in soybeans in USDA's July round of numbers. That might have been the lowest figure for 2023 production that we see going forward. And we don't know if there's going to be much demand at all outside of crush demand. I think exports are going to continue to slow down given the amount of supplies that are still available in Brazil. So from a future spreads point of view, I'd say it's still fundamentally bullish. But I would put an asterisk with that due to what we at least think we know about the market at this point.
Gotcha. Okay, cattle. We were down today despite the fact that we had some 180 cash in the South, which is undoubtedly higher than last week. And so this has been like the fourth reversal that we've seen in live cattle futures here in like the last 4 months. We've been fighting these off. Will we continue to fight off these reversals?
Yeah, it goes back to a market that can't go down, won't go down, and that certainly fits live cattle these days. We get these reversals, we see a little bit of pressure, we see some selling coming in, but by the time we get maybe 2-3 days down the road, it's all gone and it's just simply forgotten. The trend right now is up. We can look at the cash market, we can look at the futures market. Right now, it's just trending up, and as long as it trends up, we need to ride that. We need to ride it as long as we can. But we do have to be careful with this thing. Funds are long, basis is weak, cash market is firming, but it's still well below where the futures markets are sitting. So there are some concerns out there. This market could easily get overloaded to the top side, everybody running to the same side of the boat. Usually when that happens, the boat capsizes or rolls over. So we do have to be careful with this market, especially as we look down the road and we've got deferred issues priced in the 190s. That's a really high priced cattle, and I just don't know how sustainable it is.
Yeah. And what are you thinking about demand here? Boxes have obviously trailed off, but usually seasonally we start to bottom here pretty soon, don't we?
Yeah, that's the big question. How much seasonal pressure do we see on the boxed beef market, because it has broken here in July? So, we've got a couple different thoughts on this. Is it an economic indicator that the labor situation, the labor market here in the United States is finally starting